is not available for Sally. Okay, so that is question A. Let's take question B. I read that you can take us through question B. Oh shit. Take us through like 1B.
Did you say you need a reader?
Is that?
Sir, please, I have a question.
Okay.
The condition that states that the sale is highly probable and expected to be completed within a year.
Yes, please.
Can I ask, because in the question it says, the part that says it's not expected to occur until summer 20. Won't the property still be sold within a year?
It is not what?
Won't the property still be sold within the year? Because from 1st December 2017 till summer 2018, it's not up to a year.
So what?
So if you can explain the condition for me, the sale is highly probable.
It's highly probable that the sale is expected to be completed within a year.
Yes.
Mm-hmm.
Now, can you explain that for me?
It means that the sale must be completed within a year.
And with so the question, the part that says it's expected to occur until summer 2018.
Yes, even though if it even meets the condition, we said that it must meet not just that one, but then we said the assets must also be available for sale immediately. And
Okay.
there is a statement here which saying that the asset is not already available.
So if it meets like 4 requirements and it doesn't meet one, it's still not helpful.
It's still not helpful.
Okay. Thank you.
Except that maybe it's meeting 4 and there is no they didn't inform that asset is available for sale. That means it means we assume that the asset is available for sale. So if maybe they give us 4 out of this condition that we know, and all the 4 that they give us are meeting the conditions, we will assume that the rest have also met the condition. I don't know if I'm making sense.
Yeah.
Yeah.
Thank you.
Welcome. So B. Yes. Who's reading?
B. A subsidiary entity. E. Is for sale at a price of 3 million Ghana cedis. There has been some interest from prospective buyers, but no sales but no sales as of yet. One buyer has made an offer of 2 million Ghana cedis, but the directors of S&D rejected the offer. The directors have just received advice from their accountant that the fair value of the business is 2.5 million Ghana cedis. They have decided not to reduce the sale price of B at the moment. Can the subsidiary be classified as held for sale?
Okay, so this is B, right? So the first one was A.
Yeah.
So they're asking whether it can be classified as held for sale. Okay. So now, does it meet all the, before we can classify an asset as an asset held for sale, it must meet certain conditions. So from the scenarios that we were given, or the scenario that we are given from the question, does it meet all the or any of the conditions? It said a subsidiary B is for sale, the price of 3 million, right? There has been some interest from prospective buyers, but no sale as of yet. One buyer has made an offer of 2 million, but the directors of S&D rejected the offer. The directors have just received an advice from the accountant that the fair value is what? The market value, right?
Yes.
Of the business, and it's 2.5. So the market value is 2.5. They have decided not to reduce the sale of the price of B. So how much were they selling? They were selling it for 3 million. It's for sale for which price? 3 million, right?
Yeah.
But the market value, one buyer has offered to give them 2 million, but the directors rejected the offer. They are not willing to accept the 2 million. We are selling the thing for 3 million. You say you want to give us 2 million. Hey, you want to cheat us. So they have rejected that offer. But then when someone went, the accountants find out from the market, find out that the price is 2.5 at the market. So how much are they getting on 3? That means they are getting 0.5 million on it. And which of the condition is against this?
The
Which
price
of the condition?
must be
Which of
reasonable.
the? Is that what?
The asset is being offered for sale at a reasonable price.
Yes.
In relation to what? Its current market value.
Current
Yes.
value.
Not more than the fair value.
Exactly. So now, is the asset being sold at a reasonable price in relation to the current market price?
No.
No.
No, because they are selling it for 3 million. Market price is 2.5. Hey, and you are selling the thing for 3 million. The thing that it is 2.5 million. You are selling it for 3 million. So that is not meeting the condition of the asset being offered at a reasonable price in relation to its fair value. It shouldn't be more than that. So what can we say? Can the subsidiary be classified as an asset held for sale?
No.
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 So we can see that the subsidiary, what's the name? Subsidiary B, B does not, subsidiary B does not meet the criteria. Somebody is talking at the background whilst we are having FR class 8. The subsidiary B does not meet the criteria for classification. As held for sale, right? As held as held for sale. Although actions to locate the buyer are in place, the subsidiary although actions let me write it well. Although actions to locate a buyer, because you said that they've seen a potential buyer, right? Actions to locate a buyer are in place. They are in the process of locating a buyer. Are in place. Buyer are in place. A buyer are in place. The subsidiary is not for sale
Say.
It's not for sale at a price that is reasonable. At a price that is reasonable compared to the market, to its fair value, to its fair what value, to its what fair value.
Say.
Hello?
Please, a buyer has been repeated. Although
A
buyer, it has been repeated.
To locate a buyer, to locate a buyer are in place. Sorry, are in place. A buyer are in place. Hey, to locate a buyer are in place. I didn't bring the I, right? Are in place. The subsidiary is not for sale at a price that is reasonable compared to its fair value. Compared to what? Its fair value. Compared to its fair value. To you can bring the figure. So the fair value. So Obiani Nebrofo, into this is mine. You can also simplify it in the way you want, right? The key thing is for you to bring out the main thing is for you to bring out the key things that it can be classified as held for sale because it is what, because the fair value is below the sale price, or the sale is above the fair value is reasonable compared to its fair value. That is okay. So let me take it. That is the fair value. The fair value of 2.5 million is below the sale price of how much? 3 million. Full stop. Does it make sense? Hello? Hello? We proceed?
Yes, please.
Yes.
All right, so illustration 2, quickly. Illustration 2. Illustration 2. Where is illustration 2? Illustration 2. Alright. Illustration 2. Let's read that.
On 1st January 2011, AB acquires a building for 200,000 Ghana cedis with an expected life of 50 years. On 31st December 2014, AB puts the building up for immediate sale. Costs to sell the building are estimated at 10,000 Ghana cedis. Required. Outline the accounting treatment of the above if the building had a fair value at 31st December 2014 of A, 220,000 Ghana cedis and B, 110 Ghana cedis. 110,000 Ghana cedis, sorry.
Okay, so we said that AB acquires a building of what, 200,000. So that is the cost. That is the cost. That's the cost with an expected useful life of 50 years, right? On 31st December 2014. So from January 11 to 31st 14. How many years? Put the building up for immediate sale. For immediate sale. Cost to sell is 10,000. Outline the accounting treatment for the above sale. If the fair value is 220 for A and then 110 for B. So how do we measure the the IFRS 5? How do you measure it? How do you measure it?
You measure it by taking the lower of the carrying amount in the NRV. And the net is
A. The measurement criteria is the lower of the
NRV.
The lower of what?
The carrying amount in the NRV.
Exactly. So it's the lower of the two, the carrying amount and the net realizable value, where the net realizable value is a fair value less cost to sell, right? So that is the measurement. So there's nothing how to be treated. So the information given means we have to determine our carrying amount from PPE. Right? Do you remember that? Yes. PPE? Yes. I told you that PPE is the mother of all the standards. Because if you don't know PPE, that means you struggle with almost all the standards. PPE is King Kong. That is why we wasted a lot of time at PPE, so that you get a concept. We solved a lot of questions under PPE. So I know you are strong in PPE. So now, the cost of the asset. What is the cost of the asset? What is the cost of the asset?
200,000.
Cost of the asset is 200,000. Then we calculate our depreciation, right?
Yes.
Yeah, carrying amount is the cost less depreciation, right? Do you remember that? So what would be our depreciation? The depreciation will be what? What will be the depreciation? That will be what? 200.
200 divided by 50.
What is the useful life?
50.
50 years. And then how many years have it been in the business?
4.
Before the sale? How for? Why for?
2011, 2014.
On January 2011,
Yeah.
and then the sale is as at 31st December, right? And also computing for 31st December 2014. So how many years before the depreciation? So that is 11, 11, 12, 13, 14, right? So 4 years. So what would be the accumulated depreciation?
16,000.
16,000.
Yeah.
So 16,000 from 200,000.
184,000.
184,000 is the carrying amount, right? So that is the carrying amount for the what?
For the assets.
For the building. The building, right? We said that to measure it, it is the lower of what the cost and the
amount.
So what is the net realizable value? That's the what fair value
Minus fair value minus cost of sale.
So what is our fair value from A? What is the fair
120.
value? 220,000 minus what is the cost to sell?
10,000.
So that is 10,000. So what do you have as your NRV? That will be 210. Right? So now, what will be the accepted amount? The books. Which of the amount do we choose?
184,000.
IFRS is measured at the lower of CA, not chartered accountant, but carrying amount and net realizable value. So which one do we choose? Is it the 210 or the 188?
184.
Okay, so therefore the 184. So 184 is what will be recognized. All right. The value of the asset, right? And the value of the asset. Then so now we move on to the next one, which is what is the B saying? What is the B saying? But do we have any impairment? Do we have any impairment? There is no impairment.
Yes.
There is no impairment. We would have deducted the impairment from the value of the assets. Since there is no impairment, we proceed. I believe you know that impairment is what? What's the formula for impairment?
Carrying amount minus recoverable amount.
When the carrying amount is more than the recoverable amount, then that will lead to an impairment, right?
Yeah.
When the carrying amount is more than the recoverable amount. So that is here, the recoverable amount is higher than the carrying amount. So there would be no impairment. Have we treated impairment? Have we done impairment?
No, we'll do it
This week.
You say you do it what?
this week.
In class you've not done impairment.
No.
Okay. Have you done IFRS 5?
Yes.
Oh, I see. Then it's like a revision to you guys.
Yes.
Okay, so now the current amount is still 185, right? To be the net realizable value is the fair value. The realizable value is what? So what is our fair value for P? That is 110,000 minus the cost to sell and the cost to sell. So what will be the value?
100,000.
100,000. Okay. So now 100,000, and so we said that IFRS measured at low. So what is the lower? The lower is what?
The 100,000.
So the lower here is 100,000. Do you have any impairment? Do you have any impairment?
Yes.
So what is the impairment?
100,000.
The impairment is 100,000.
Yes.
Really? I see. All right. So the impairment is the difference when the carrying amount is more than the recoverable amount or the net realizable value here. Okay. So you here is 100. The impairment is 84,000.
Why?
So what do you do with the impairment? The impairment is treated the same way the depreciation. So that impairment would be deducted from the value of the asset. The impairment will be deducted from the value of the asset. So if it will be deducted, then what does it mean? It means it will debit the and also it is an expense. What do we do to depreciation? What do we do to depreciation? How do we treat depreciation in the P&L, in the profit and loss?
As an expense.
As an expense, right? So we debit P&L
Yes.
with the impairment of what?
84,000.
Impairment of 84,000. Then what do we credit? We credit what do we credit?
Impairment.
We credit what? We credit the assets. Depreciation. Only are preparing the non-current assets and the statement of financial position. You see that you write land and building cost less what accumulated depreciation, right? And then you get the net book value. Do you remember that?
Yes.
So here the impairment would also be deducted from the cost, from the value of the asset. So we are going to credit. Asset is having a debit balance. So if you are crediting it, it means you are reducing the amount. Asset is having a debit balance. So here the asset is the building. Is the building. Asset is having a debit balance. So if you are reducing it, that means you credit it. So you credit it with the impairment, still with the impairment amount. Impairment amount. Impairment is like the depreciation. We treat it the same way we treat the depreciation. So that is it for the question 2. Any question? Any question? Any question? All right. So then let's solve the third question and then we call it 9th. I've been giving you a lot of assignments, but you don't submit it. Don't worry. Young as my busy, so don't worry. I'm even happy you are not submitting it.
I submitted one. You didn't look at it.
I didn't what?
You didn't look at it.
Oh, see that I
It
opened
was
and
under.
then
Yes, it
did
was
I
under
open
inventory. I don't know because I've sent off my read with it.
who is that?
Nsakosua.
I don't remember. But anyway, remind me again so that I look at it.
Okay.
Alright, so let's solve the last question and then call it the ninth. Okay, so reader, I'm waiting for you.
S&D set a building for its own use on January 2011 for 1 million Ghana cedis and attributed it a 50-year useful life. S&D used the revaluation model to account for the building. On 31st December 2004, the building was revalued at 1.2 million Ghana cedis. On 31st December 2013, the building met a criteria to be classified as assets held for sale. Its fair value was deemed to be 1.1 million Ghana cedis, and the cost necessary to sell the building were estimated to be 50,000. S&D does not make reserve transfer in respect to excess depreciation required. Discuss the accounting treatment of the above.
So okay, so S&D, limited, purchase a building for its own use, so that is PPE, on 1st January 2011 for 1 million and attributed it a 50-year useful life. S&D uses the revaluation model to account for the building. All right, so what is the question? Discuss the accounting treatment for the above. All right, so let us determine the carrying amount of the asset. Let us determine the carrying amount of the asset. Determine the carrying amount of the asset. All right, so what is the carrying amount? It is the cost less depreciation. So cost, what is the cost of the asset? 1 million, right? So that will be 1,000 because I have 3 zeros at the top. To be our depreciation, to be our accumulated depreciation,
1 million over 50.
1 million over 50 years times what? What is the number of years? Purchased on which date? 1st January 11. It has been in the business. When was the revaluation? Revaluation. Well, how many years before the revaluation?
2 years.
Yeah, 2 years. 1st January 11 to 31st 11 is 1 year. Then 1st January 2012 to 31st 2012 is 2. So 2 years. 2 years.
I don't get it.
You don't get it. Who is that? Which part don't you get?
It's from 2011 to 2013.
No, 2012. I mean the date before the revaluation. And not the date that it was classified as held for sale. We are doing PPE revaluation. All right, you get it. Okay. So how many years? 2 years. All right.
Yeah.
So what are you getting?
40,000.
40,000. So that will be 40. 40. Okay. So if you deduct 40, what are you getting? That will be 96. 96. All right. So this is 96. This is so this is carrying amount, right? Carrying amount as at 31st was December what? 2012, right? That's the carrying amount. And what is the revaluation amount? Revalued amount? Revalued amount is how much?
1.2 million.
So that'll be 1,200. So what do we have? Do we have revaluation surplus or revaluation deficit? Revaluation surplus or deficit or loss?
Surplus.
Revaluation surplus. And what is the difference?
$240.
240. All right. So this is the revaluation surplus. Revaluation surplus. So you can see that here they can combine PPE and then IFRS 5. You see, they can combine PPE and IFRS 5. If you don't know PPE, you see, you'll be stranded here. So you shouldn't mix any of the classes. Because if you don't mix it and you don't get PPE, that means you are going to struggle here. Because if you are moving fast, you're not coming to explain basic stuff, because we have done that already. So what do you think will happen? What will we do with the surplus? The surplus would be treated as what? Will be added to the asset, right?
Yeah.
Will it be added to the asset?
To be debited to the asset account and then start with the OCI.
Exactly. Wow. Some of you are learning, you are learning that me, I'm always sleeping. All right. So, yes, that is the case. So, we will debit the assets with the revaluation surplus to add up to the cost. Debit asset 240 and then credit OCI. OCI 240. All right. Now, this is the revaluation amount. So now let's come to the IFRS 5. It said on 31st 13, to the one who was asking why not 13, or who was confused with the 13. On 31st December 2013, the building met the criteria to be classified as held for sale. Its fair value is deemed 1.1 million, and the cost necessary to sell the building were estimated 50,000. So it's not difficult. You understand the concept? All right. So its value was deemed to be 1.1 million, and the cost necessary is what? 50,000. The fair value is market value, right? 1.1. So what do we do? So we need to find the carrying amount before. So the carrying amount that we have is as at what date? As at 31st December 2012. But now we are here, 31st December 2013. So we need to find a revalued amount as at that date. So this value is as at what date? 31st, right? December 2012. So we need to find a depreciation. So that to get the carrying amount as at 2013. So that will be how many years? That will be how many years?
1 year.
1 year.
1 year.
1 year. That is 1 year. Now, with the depreciation, we have already, it is 50 years, and we have already used how many years?
2 years.
We have already used 2 years. So how many, we've got the remaining useful life?
48.
48. So 48 times 1. So 48, that is already 1 year, right? So that will be like this. So what are we getting?
25.
25. So what is the balance? What is the carrying amount as at 31st December 2013?
1,108.
What are you getting?
1,175.
1,175. 175. So that's the carrying amount, right? Now, what is the fair value? Now we have the carrying amount as at that date. So now we can compare it to the fair value as at that date. Fair value as at 31st December 2018. So we have the carrying amount. So if you compare it to the 1 million, that's where it will determine whether. All right. So what is the fair value as at that date?
1.1 million. 1.1 million.
1100. So what can we say? What can we say?
It's an impairment.
There's what? What can we say, please? But wait, with the fair value, I think there's a fair value less cost to sell, right? Where the cost to sell 50,000.
Yeah.
You want to see that? So less cost to sell. What is the cost to sell? 50,000. Anna.
Yeah.
I can't see that. Can you see that? So what do we have?
1,050. Okay. 1,050. Okay. Now, I'm a business here.
Let me separate it before someone. So we are getting 1,050 as the what net realizable value. So is there any impairment? Is there any impairment?
Yes.
There is an impairment. So what will be the impairment? That will be the carrying amount being more than
125.
Yeah.
So what do we do? So what do you do to the impairment?
You left it from the
cost.
What? The cost. You debit what?
profits and
You debit profit. We debit fee now.
Yeah.
With 125.
You debit P and L
And credit what? And credit what?
asset.
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 Okay. So I believe you are fine. Any question? Alright, so in the absence of no question, assume that you are fine. And this is where we would end. We continue another time. Thank you very much. Have a wonderful evening. Good night.
Thank you.
Thank you too. God bless you.
Good night.
Thank you.